Intercontinental Hotels Group missed synthetic quarterly consensus estimates for the first half of 2026.
Yep, right out of the gate.
Right. Total IFRS revenue came in at $2.66 billion, which, is actually up 5.6% year over year, but it missed the $2.70 billion consensus.
And the EPS numbers were just as jarring on the surface.
Exactly. Reported headline EPS was $1.37, completely missing the $2.65 synthetic quarterly estimate, though their adjusted first-half EPS was actually 274.7 cents.
Which is a completely different story.
It really is. Full-year guidance was maintained, with adjusted interest expense narrowed to between $230 and $240 million, and an adjusted tax rate of 26 to 27%.
So the fundamentals are, well, they're steady.
But the stock still took a defensive hit. It dropped roughly 2% in after-hours and pre-market trading to around $152.53 before sort of hovering near $155 during the regular session.
Which is wild when you actually look under the hood.
Yeah. On paper, that headline looks like a massive multinational company suddenly stalling out. But if you hold this stock, do not panic sell just yet. Because, honestly, we are looking at one of the most fascinating accounting mirages of the entire year.
It really is a mirage. I mean, the immediate market reaction makes perfect sense if you're just an algorithm scanning the morning headlines.
Sure.
But it completely falls apart once you look at the actual plumbing of how this company is required to report its data. You basically have this fundamental clash in financial reporting structures playing out in real time.
Okay, let's unpack this, because this is the core of the confusion, right?
Right. So IHG is a dual-listed entity. They trade in London and New York, but they compile their financials under International Financial Reporting Standards, IFRS. And they do this on a half-year schedule.
Not quarterly.
Exactly. Meanwhile, the entire U.S. financial apparatus, the Wall Street analysts, retail brokerage platforms, the automated trading bots, they all demand a strict quarterly rhythm.
The systems literally require inputs every 90 days. And because IHG just doesn't provide them, these U.S.-centric financial databases basically invent them. They create these synthetic quarterly estimates to fill the void.
They're essentially modeling what a quarter would look like if IHG actually reported one. They just split the difference based on broader industry trends.
So when the actual half-year numbers finally drop, they just crash head-on into those synthetic models,
creating this massive reconciliation issue. It's like taking a panoramic photo while the subject is walking across the frame.
Oh, yeah, the resulting image looks totally distorted.
Right. But the subject themselves is perfectly fine. Take their pre-tax profit, for example. The headline showed an 8.7% drop down to $578 million.
Which looks terrible. If you're a retail investor seeing that red flash on your phone, that implies structural decay.
It does. But when we look at the mechanics of that specific line item, the decline was almost entirely driven by foreign exchange volatility, not, a sudden inability to book hotel rooms.
Right, because this is a massive global operation. They're earning revenue in dozens of different currencies. So translating all that cash flow back into their reporting currency just creates a ton of noise.
A tremendous amount of noise. Last year, in the first half of 2025, IHG benefited from a huge $79 million foreign exchange gain, just from currency fluctuations. Yeah. But this year, the pendulum swung the other way, and they absorbed a $7 million foreign exchange loss. That year-over-year delta accounts for the bulk of that 8.7% decline.
So it's not the actual business degrading.
Not at all.
Yeah.
If you strip that currency distortion out of the equation, the core business narrative flips completely. Adjusted earnings actually rose 13% to 274.7 cents per share.
Which is huge.
And their core operating profit grew 10%. The real kicker here is that the reported pre-tax profit of $578 million actually beat the underlying true consensus estimate of $560 million.
See, it's like translating a temperature from Celsius to Fahrenheit, getting confused by the resulting number, and just deciding the weather is too cold to leave the house.
That is exactly what happened here.
The market penalized the stock because the translation sounded worse than the reality. But let me push you on the long-term impact of this.
Okay.
Do retail investors and Wall Street eventually price in this accounting noise? Or does this structural reporting mismatch just permanently weigh on the ADRs? Because, if you hold this stock in a retail portfolio, you don't want your position taking a 2% haircut twice a year just because an algorithmic trading desk got confused.
Yeah, I mean, sophisticated institutional money looks right past this. Analysts who are building these deep, multi-year discounted cash flow models, they care about the 10% operating profit growth. They don't care about the synthetic quarterly
And
misses.
see the real numbers.
Exactly. However, in the short term, algorithmic trading driven by natural language processing and just retail sentiment can absolutely cause this localized volatility.
Right.
Over a 5-year horizon, underlying cash flow always dictates the valuation. But
Yeah.
capturing that value requires you to understand the reporting mechanics well enough to just ignore the false signals.
Because putting heads in beds is the actual reality behind all this accounting. And looking past the currency swings, the physical performance of the properties tells a really specific story about the global consumer right now.
It really does.
I saw in the data that global RevPAR revenue per available room increased by 4.1% in the first half of the year. Now, I know the Americas region carried the weight here with 4.8% RevPAR growth, but were the EMEAA and Greater China regions even close to that?
They lagged, but they still posted pretty solid numbers. EMEAA, which is Europe, the Middle East, Asia, and Africa, reported 3% RevPAR growth, and Greater China reported 3.1%.
Not bad at all.
No. But what is crucial to understand about that global 4.1% blended average is the mechanism behind it.
Yeah.
The industry breaks RevPAR down into two components, occupancy and average daily rate, or ADR.
Right. You can grow revenue by cutting prices just to fill empty rooms, or you can raise prices on the exact same number of guests.
Exactly. And IHG managed to do both simultaneously,
They saw a 1% increase in occupancy combined with a 2.5% rise in the average daily rate.
which is incredibly hard to pull off.
Putting more people into the system while actually retaining the pricing power to charge them more per night, that's the holy grail for a hotel operator.
Certainly.
But what I found really fascinating in the source material was the demographic shift in who is actually paying those higher daily rates, because the demand drivers have completely rotated compared to that crazy post-pandemic travel boom.
Oh, absolutely. Group travel is aggressively taking the wheel right now. Globally, group travel bookings surged 6%.
6% is massive.
And when you isolate just the Americas region, group travel was up a staggering 10%. That vastly outpaced leisure travel, which only grew by 3%,
Right.
and regular transient business travel just ticked up by 2%.
We are seeing a fundamental shift in how corporate budgets are being deployed. It is the revenge of the convention.
The revenge of the convention. I love that.
Yeah, I mean, people are returning to large-scale corporate offsites, association meetings, industry trade shows, but as an investor analyzing sustainable demand, is this heavy reliance on group travel actually a sturdy foundation?
That's the big quote.
Or is this just the delayed rubber band effect from the past few years that is finally about to snap? You know, every company rushed to do their postponed team-building events, and now the event budget is just tapped out.
Right. Well, management's stance is that this represents structural normalization. With the entrenchment of hybrid work models, corporate budgets for these large offsites are actually expanding.
Really? Expanding?
Yeah, because companies are realizing that if their workforce is distributed for 50 weeks out of the year, they absolutely need to spend aggressively on those 2 weeks of face-to-face culture building.
Oh, that makes sense.
And group bookings are highly coveted by hotel operators because of the visibility they offer. A 500-person convention is booked and contracted months, sometimes years, in advance.
But that visibility is a double-edged sword, though.
How so?
If we see a broader economic slowdown and corporate profits start getting squeezed, those massive mega events are historically the very first line item a CFO redlines. You can cancel a Las Vegas convention significantly faster than you can execute corporate layoffs.
That vulnerability is very real. But the mechanics of group travel actually insulate the hotels in the short term. Those contracts come with severe cancellation penalties.
That's the point.
If a corporation pulls out of a major event, the hotel still collects a significant portion of the revenue. And they do it without having to bear the housekeeping and food costs for the attendees.
Wow, so pure profit, in a way.
Basically.
Yeah.
Furthermore, establishing a solid base of group bookings early allows the hotel's revenue managers to just aggressively push up the average daily rate on the remaining available rooms.
For those last-minute leisure or business travelers?
Exactly.
Here's where it gets really interesting. Because top-line revenue growth and high daily rates are great for the individual property owners, sure. But the real question is how much of that premium survives the journey down to IHG's bottom line.
Right, the corporate take.
Revenue only grew 5.6%. But operating profit from reportable segments jumped 10% to $665 million. That implies some serious margin expansion occurring within their corporate structure.
And it is. The profit jump is a direct result of IHG's fee margin expanding by 120 basis points, reaching 65.9%.
Which is huge for a company this size.
It is. To understand how they generate a 10% profit bump on mid-single-digit revenue growth, you really have to look at the architecture of their business model.
I always look at IHG's franchise structure as basically an asset-light toll booth.
That's a great way to frame it.
They don't own the vast majority of these buildings. They aren't laying bricks, pouring concrete, or negotiating with local construction unions for every single new hotel.
No, they let the developers handle that headache.
Right. They just provide the intellectual property, the brand flag on the roof, the central reservation system, the loyalty program, and in return, they collect a percentage of the gross room revenue from the actual property owners.
And that asset-light approach is the core engine of their cash flow. Because IHG is largely insulated from the heavy capital expenditures required to maintain physical real estate.
The new roofs, the HVAC system.
Exactly.
Wow.
Replacing the plumbing, renovating the lobbies, all of that falls on the owner. So almost all of the incremental revenue generated from those higher daily rates drops straight through IHG's income statement to the bottom line.
It's incredibly efficient.
Management's long-term growth algorithm actually targets 100 to 150 basis points of annual fee margin expansion precisely because of this dynamic.
Oh, yeah.
By maintaining low capital intensity, their goal is to convert roughly 100% of their adjusted earnings directly into free cash flow.
But let me challenge the sustainability of that algorithm. At what point does fee margin expansion hit a structural ceiling? I mean, you can only squeeze so much efficiency out of your corporate operations before it begins to degrade the brand quality. You can't just keep raising the toll on the highway without providing value. Eventually, those independent hotel owners are going to pull the IHG flag off their building and switch to a Marriott or a Hilton.
That tension between the corporate franchisor wanting higher margins and the franchisee wanting lower fees, that is the central conflict of the entire hospitality industry.
No. Right.
But IHG's margin expansion isn't really driven by gouging the property owners with higher percentage fees. It is driven by operating leverage.
Okay. Explain that.
When IHG adds thousands of new rooms to their global system, their central corporate costs, the headquarters payroll, the global IT infrastructure, the marketing campaigns, those don't scale up at the same rate.
I see.
You're spreading a relatively fixed cost base over an ever-expanding pool of revenue.
So the math only works if the system is constantly expanding. The toll booth becomes more profitable through sheer volume, not by aggressively hiking the toll itself. Which means the entire investment thesis rests on their ability to continually sign new properties and add rooms to the network.
And according to the first half data, the network is expanding at an incredibly rapid pace. They recorded 5% net system growth, marking their strongest expansion pace in 7 years.
7 years! That's serious momentum.
They opened 197 new hotels, adding 31,500 rooms to the active system. And looking at the forward pipeline, they signed an additional 352 properties.
Signing 352 properties in 6 months means they are securing nearly 2 new hotel deals every single day. That requires a massive sales apparatus. Are they convincing developers to build new hotels from the ground up, or is this driven by converting existing independent hotels into IHG brands?
It is heavily weighted toward conversions right now, which makes sense given the high cost of construction debt in the current interest rate environment.
It's just too expensive to build from scratch.
Exactly. An independent hotel owner facing rising operational costs and struggling to drive direct bookings is highly motivated to plug into IHG's global distribution network.
Makes total sense.
And because of that 100% free cash flow conversion we discussed, IHG has a massive war chest of surplus capital to incentivize those conversions.
And to reward shareholders, clearly.
Oh, yeah. They are on track to return over $1.2 billion to shareholders in 2026 alone. That is comprised of a $950 million share buyback program and an interim dividend that they just raised by 10% to 64.5 cents per share.
Returning $1.2 billion is a highly aggressive capital allocation strategy. But the sources also detail significant capital being pushed back into the business, specifically targeting technology.
Yes, the tech spend is a big part of the narrative.
They are rolling out a cloud-based property management system to 4,000 hotels and investing in an AI-powered content platform. But I have to throw a flag on this.
Oh.
Every single earnings report across every sector right now mentions AI. Is management just feeding the buzzword machine to appease the automated trading algorithms, or do these systems actually lower operating costs for hotel owners?
Well, skepticism around AI buzzwords is entirely warranted right now. But the hospitality sector is actually one of the few areas where machine learning offers immediate, quantifiable utility.
How so?
The technology ecosystem is the primary justification for the franchise fee. Think about dynamic pricing. If IHG's new cloud property management system can analyze local event data, competitor pricing, and historical booking curves in real time,
It can adjust on the fly.
yes, it can optimize room rates far more effectively than any human revenue manager sitting in a back office.
So the technology creates this self-reinforcing loop. The independent owner pays the franchise fee to access the AI pricing engine. The pricing engine increases the property's average daily rate.
Exactly.
And that higher rate generates more total revenue, which in turn increases the absolute dollar amount of the percentage fee that flows back to IHG corporate.
And that allows IHG to reinvest even more into that technology, widen their competitive moat against smaller hotel chains that simply cannot afford to build global cloud infrastructure.
It basically makes leaving the IHG ecosystem financially irrational for the property owner.
That's the ultimate goal, yes.
So what does this all mean for the big picture? We have a robust development pipeline, record daily signings, aggressive shareholder returns, and systemic margin expansion. Yet, as we noted at the top, the stock still took a defensive posture.
There were definitely some storm clouds in the report.
Let's transition to the structural risks embedded in this data, because there are glaring regional cracks that clearly spooked investors.
The earnings report highlighted two severe red flags in the regional data that really require immediate attention. The first is geopolitical. In the EMEA region, specifically the Middle East, revenue absolutely plummeted by 19%.
19%, that's a free fall.
Management directly attributed this to the ongoing conflicts involving Iran and the subsequent disruptions to international travel routes.
Look, for an investor, seeing a 19% revenue collapse in a major geographic zone is panic-inducing. The vulnerability of the hotel model is that these are fixed physical assets.
Right, you can't move the building.
If a conflict zone erupts 500 miles away and international airlines reroute their flights to avoid the airspace, the tourism traffic vanishes overnight. But that specific hotel still has to pay property taxes, security, and maintenance.
That is the ultimate risk of the asset-light model for the franchisee, certainly. Now, IHG corporate is somewhat shielded from the direct operating losses of the physical building.
But they still take a hit.
Oh, definitely. IHG still loses the high margin fee revenue when traffic drops to zero. But the second red flag is purely macroeconomic, and it's centered in Greater China.
Which has been a powerhouse for them.
Historically, yes. The region started the year with strong momentum, but in the second quarter, RevPAR growth severely decelerated, flatlining to just 0.8%.
Less than 1% growth in China is a massive headwind. This is a market that the entire hospitality industry has relied upon as a relentless engine for global travel demand over the last decade.
Absolutely.
Now, management did attempt to deploy a macro safety net to counter this narrative on the earnings call. They pointed to the creation of 100 million new global jobs, a projected 7% rise in global wealth, and massive future catalysts like the 2026 World Cup.
The World Cup will definitely move the needle.
For sure, as reasons to remain bullish on structural travel demand. But I want to pose an analytical question.
Go ahead.
Is IHG's vast geographic footprint acting as a sufficient shock absorber? Or are these regional fractures in China and the Middle East early warning indicators of a global consumer recession?
The shock absorber theory is the core bullish argument for holding a multinational hospitality stock like this. The Americas region is running so hot, fueled by that 10% surge in group travel we talked about, that it mathematically masks a 19% collapse in the Middle East and a near stall in China.
So the aggregate numbers still show 4.1% global growth.
Right. That is the very definition of a diversified portfolio working as intended to smooth out regional volatility.
If one engine on the aircraft flames out, the plane maintains altitude because the other engines are running at maximum thrust.
That's the bull case. The bearish counterargument is that the Chinese consumer is historically a leading indicator for global discretionary spending.
The canary in the coal mine.
Exactly. If domestic economic weakness in China is suppressing travel and geopolitical instability in the Middle East is severing major long-haul aviation routes, the contagion risk is incredibly high.
How long before that localized negative sentiment bleeds into corporate travel budgets in Europe and the Americas?
That's what the bears are watching. Management is making a calculated bet that overarching global wealth creation and the inelastic demand surrounding mega events like the World Cup will provide enough structural momentum to bridge these regional soft patches.
It sets up a really fascinating race between long-term structural travel tailwinds and the immediate gravity of macroeconomic pressure.
It does. And if we pull back to look at the broader horizon, there is a quiet evolution occurring within the hotel business model that wasn't splashed across the headline numbers, but is vital for anyone analyzing this sector to consider.
Where's that?
IHG is rapidly scaling brands like the Noted Collection and Ruby. Beyond traditional lodging, management specifically highlighted their residences business, explicitly stating they expect it to become a material contributor to their bottom line by 2027.
Wait, when you say residences, you mean actual real estate, like high net worth individuals buying condos to live in full time.
Exactly that. Branded luxury real estate. This forces us to ask a fundamental question about valuation. Are traditional hotel operators transforming into branded asset-light real estate developers?
That is a wild shift.
They are no longer simply selling a transient bed for a Tuesday night. They are licensing their brand halo to luxury residential towers, managing the complex, and collecting high-margin fees on multi-million-dollar real estate transactions and decades-long property management contracts.
That completely shifts the math on how an analyst would calculate their multiple. It basically brings us full circle to the mirage we started the show with. What appears on a synthetic stock chart to be a simple lodging company missing a quarterly estimate is actually a highly complex asset-light real estate and technology engine operating underneath. For more deep dives and your daily, no-nonsense earnings coverage, make sure to follow the show.